There is a ghost in the machine of modern finance. It's a phantom that whispers in the ear of every investor, every entrepreneur, every ambitious person striving for financial freedom. It tells a seductive story, a story of titans and wizards, of garage startups that become global empires, and of stock charts that only go up and to the right. We see it on the covers of magazines, we hear it in podcasts, we read it in best-selling business books. The story is always the same. Find out what the winners did and copy them. Study the habits of billionaires. Deconstruct the strategies of the most successful companies. Follow the blueprint of the victors, and you too shall be victorious. It is the great, unifying myth of our economic age. And it is lethally, catastrophically wrong. The single most important secret to building lasting wealth, the bedrock principle that separates the consistently successful from the crowd of hopefuls who boom and bust, is not found in the gleaming headquarters of the world's most celebrated companies. It's found in the overgrown graveyards of the ones that failed. The key to winning is not to study success, it is to study with a forensic, almost obsessive intensity, the anatomy of failure. Warren Buffett, a man who has compounded capital at a rate that defies financial gravity for over 60 years, has said that his partner, Charlie Munger, opened his eyes to this truth. Charlie, he's often remarked, taught me that it's much better to learn from other people's mistakes. While the world is desperately trying to clone the DNA of success, Buffett and Munger have spent their careers cataloging the pathogens of disaster. They understand a fundamental truth that eludes 99% of market participants. In the complex game of investing, a game of incomplete information and psychological pressure, avoiding stupidity is a more reliable path to wisdom than seeking brilliance. This is not a defensive posture, it is the most potent offensive strategy you can possibly deploy. Because by understanding the common patterns that lead to ruin, the recurring themes of leverage, ego, complexity, and competitive decay, you can build an intellectual filtration system. You can create a checklist of business pathologies, a series of red flags that allow you to eliminate the vast majority of bad ideas before they ever have a chance to damage your portfolio. This is the great inversion. Instead of trying to find the one needle of success in a haystack of mediocrity, you simply burn the haystack. You steer clear of the losers, the blow-ups, the value traps, and the frauds. And in doing so, you are left with a much smaller, much higher quality universe of opportunities. Protecting your downside is not about being timid. It is about ensuring you stay in the game long enough for the magic of compounding to do its work. The first rule of investing, as Buffett famously says, is to never lose money. The second rule is to never forget the first. But what no one ever tells you is how to follow that rule. The how is not a secret formula for picking winners. The how is a systematic process for avoiding the predictable, repeatable ways that people lose. Today, we build that system. We will not be studying the victors. We will be performing an autopsy on the vanquished, and in their silent lessons, we will find the final promise of capital preservation. Our journey begins with the foundational idea itself, the intellectual shift that underpins this entire strategy. We will call it the inverted blueprint, the very architecture of avoidance. To grasp this, we have to travel back in time, not to a frantic trading floor, but to a quiet conversation between two of the greatest financial minds of the 20th century. In the early days of their partnership, Warren Buffett was already a phenomenal investor. He was a disciple of Benjamin Graham, a master of quantitative analysis, a human calculator who could sift through financial statements and find companies trading for less than they were worth. He was already building a fortune, but his thinking, as brilliant as it was linear. He asked, "What makes a business a good buy?" It was Charlie Munger who introduced a different, more powerful question. What makes a business a terrible buy? Munger, a man whose mind is a latticework of mental models drawn from physics, psychology, biology, and history, brought Buffett the wisdom of a 19th-century German mathematician named Carl Jacobi. Jacoby was known for a peculiar mental habit. When faced with a difficult problem, he would often say, "Invert, always invert." If you're trying to prove something, he reasoned, it's sometimes easier to assume the opposite is true and see where that leads. If you're trying to achieve a goal, like happiness, it's often more productive to first identify all the things that would guarantee misery, envy, resentment, addiction, and then assiduously avoid them. Munger applied this to business and investing. Instead of asking, "How can we make a lot of money?" he taught Buffett to ask, "What are all the ways we could lose a lot of money?" and then build systems to prevent those outcomes. This subtle shift in perspective was revolutionary. It changed the entire game from one of prediction to one of avoidance. One of the most powerful illustrations of this principle, ironically, comes from one of Buffett's biggest self-admitted mistakes, the acquisition of Dexter Shoe Company in 1993. On the surface, it looked like a classic Buffett investment. Dexter was an American shoe manufacturer with a long history, a solid brand, and a record of consistent earnings. It appeared to have a durable competitive advantage. Buffett was so confident that he paid for the acquisition not with cash, but with Berkshire Hathaway stock, a decision that would ultimately cost his shareholders billions of dollars. So what went wrong? A forward-looking analysis would have focused on Dexter's strengths, its brand, its profitability, its American-made heritage. An inverted analysis, however, would have asked a different set of questions. It would have asked, what could destroy this business? What is the single greatest threat that could render all of its past strengths irrelevant? The answer, which became painfully obvious in hindsight, was the erosion of its competitive moat by low-cost foreign manufacturing. An inverted due diligence process would have put this threat at the very top of the list. It would have forced them to analyze the base rates of survival for domestic textile and apparel companies in the face of globalization. It would have prompted questions like, are there powerful, irreversible economic forces at play here that we cannot control? Has any company in a similar position successfully navigated this transition in the long run? Instead of being seduced by the company's past performance, they would have been sobered by the future probabilities of its industry. The failure of Dexter Shoe became a multi-billion-dollar lesson for Buffett in the power of inversion. He had focused on what made it good, not on the single fatal flaw that would make it worthless. The pain of this mistake, paid for in his own precious Berkshire stock, seared the inverted blueprint into his mind forever. He learned that you can get 100 things right in an investment, but if you get one critical thing wrong, if you fail to identify the one vector that can lead to permanent capital loss, the other 100 things don't matter. It's a lesson that is fundamental to any sophisticated wealth management strategy, and one that separates the professional from the amateur in the field of capital allocation. The power of this inverted approach lies in how it systematically short-circuits the most common cognitive biases that lead investors astray. Our brains are not naturally wired for the probabilistic thinking required for successful investment analysis. We are wired for narrative, for simplicity, for quick judgments. Inversion is a form of mental discipline that acts as a corrective lens for our flawed mental hardware. The first and most insidious bias it helps to overcome is confirmation bias. This is our natural tendency to seek out and favor information that confirms our existing beliefs, while ignoring or devaluing information that contradicts them. When an investor gets excited about a new technology stock, for example, their default behavior is to Google reasons to buy stock X. They will click on bullish analyst reports, read glowing articles about the visionary CEO, and join online forums filled with other enthusiastic believers. This creates a powerful echo chamber that reinforces their initial impulse. Inversion shatters this echo chamber. The inverted investor, upon getting an idea, consciously forces themselves to ask, why might I be wrong? What is the strongest bear case against this company? They actively seek out the most intelligent, articulate critic of the stock. They read the short seller reports. They try to argue from the perspective of a competitor. This process of searching for disconfirming evidence is unnatural and requires conscious effort, but it is the only way to get a clear, unbiased picture of the investment landscape. It protects you from falling in love with a story and allows you to see the risks that the euphoric crowd is willfully ignoring. The second bias that inversion neutralizes is overconfidence. We all tend to overestimate our own abilities and the accuracy of our forecasts. In investing, this is a deadly sin. An overconfident investor might make a large, concentrated bet on a single company, believing they have a unique insight that the market is missing. The pre-mortem, a practical application of inversion, is the perfect antidote. By forcing yourself to imagine a future where your decision has led to disaster, you are forced into a state of intellectual humility. You have to confront the possibility that you are not as smart as you think, that there are variables you haven't considered, and that luck plays a much larger role than your ego wants to admit. This exercise tempers enthusiasm with a healthy dose of paranoia, which is an essential trait for long-term wealth preservation. It is a core component of any serious financial education, teaching us that the first step to making good decisions is acknowledging our own capacity for making terrible ones. So how do we translate this powerful philosophy into a practical, repeatable tool that anyone can use? The answer is a mental model known as the pre-mortem. This technique, developed by psychologist Gary Klein, is a staple of high-stakes executive decision-making and is a perfect blueprint for any retail investor looking to improve their due diligence. It is the tactical application of strategic inversion. Imagine you are considering an investment in a hypothetical company, let's call it Innovate Corp. You've done your initial research and you're excited. The company has a new product, growing revenues, and a charismatic CEO. The story is compelling. Now, before you even think about hitting the buy button, you conduct a pre-mortem. Step 1 is to gather your investment committee, even if it's just you, and state the following premise. Imagine it is 2 years from today. We have invested a significant portion of our capital in Innovate Corp, and the investment has been an unmitigated disaster. The stock is down 80%. It was a catastrophic mistake. Our mission for the next 30 minutes is to write the story of how that happened. Step 2 is the creative and crucial part of the exercise. Each member of the team, or just you yourself, independently writes down every conceivable reason for the failure. You don't hold back. You invent a plausible narrative for the collapse. Perhaps a larger competitor copied Innovate Corp's technology and used their scale to launch a price war, crushing their margins. Maybe the charismatic CEO, it turns out, was a master of promotion but a terrible operator, and the company's expenses spiraled out of control. Or perhaps a key patent was invalidated in court, rendering their supposed competitive advantage worthless. Maybe a change in government regulation made their flagship product obsolete overnight. Or it could be as simple as a hidden mountain of debt on the balance sheet that came due during a credit crunch. You must be specific and brutal in your storytelling. Step 3 is to share these stories of failure and consolidate the potential causes. You will likely find several recurring themes. You are no longer looking at the company through rose-tinted glasses. You are now staring at a detailed map of all its potential landmines. This list of potential failure points becomes the foundation of your real due diligence. Step 4 is to turn this map of landmines into your direct investigation plan. For each potential cause of failure you identified, you must now seek out evidence to either validate or invalidate that risk. If you worried about a competitor, your task is now to do a deep dive into the financial strength and strategic intentions of that competitor. If you worried about the CEO's operational skills, you must now scrutinize the company's expense reports and cash flow statements from the past 5 years. If you worried about patent protection, you must now investigate the status of their intellectual property. The pre-mortem doesn't give you the answers, but it forces you to ask the right, and often uncomfortable, questions. It transforms your investment analysis from a passive act of collecting positive data points into an active hunt for hidden dangers. This single exercise is one of the most powerful risk management tools available to any investor, turning the abstract idea of inversion into a concrete, actionable process for portfolio protection. To truly appreciate the wisdom of this inverted approach, we must spend some time examining its opposite, the path of the 99%. The average investor operates on a completely different and deeply flawed set of principles. Their journey is guided not by a map of what to avoid, but by a siren song of what to chase. It begins with a narrative. They hear about a revolutionary technology, artificial intelligence, cryptocurrency, gene editing, and they become captivated by the sheer scale of the potential. The story is so big, so transformative, that it overwhelms all other considerations. They aren't asking, how could this go wrong? They are asking, how high could this go? This is the mindset that fueled the dot-com bubble of the late 1990s. During that period, investors abandoned the timeless principles of business valuation. They stopped looking at profits, cash flows, and balance sheets. The only metric that seemed to matter was eyeballs or clicks. Companies with no revenue and no viable business model were awarded multi-billion-dollar valuations based on a story about a new paradigm. An investor performing a pre-mortem on a company like Pets.com in 1999 would have easily written the story of its failure. The company spends millions on Super Bowl ads and expensive infrastructure to ship low-margin bags of dog food at a loss. They are burning through cash at an astonishing rate with no clear path to profitability. A recession or a tightening of capital markets will bankrupt them. It was a simple, obvious story of failure, yet millions of investors, caught in the euphoric narrative of the internet revolution, couldn't see it. They were focused on the potential upside, blinded to the near certainty of the downside. The result was one of the greatest mass destructions of capital in modern history, a textbook example of what happens when an entire market forgets to invert. This path of chasing stories and ignoring fundamentals is not just a historical anomaly. It repeats in every market cycle, from the housing bubble of the mid-2000s to the speculative excesses in certain technology stocks today. It is the default human approach to investing, and it almost always ends in tears. The financial connection, the tangible result of embedding this inverted blueprint into your decision-making process, is both profound and mathematically undeniable. It is about fundamentally altering the probabilistic profile of your portfolio. Think of the stock market as a giant barrel filled with thousands of marbles. A handful of these marbles are brilliant gold, the long-term multi-bagger winners. A larger number are solid silver, good, reliable companies that will provide decent returns. But a vast portion, perhaps more than half, are made of crumbling clay. These are the companies destined for mediocrity, bankruptcy, or outright fraud. The typical investor spends all their energy trying to develop a system to pick out the few golden marbles. It's an incredibly difficult task, requiring skill, patience, and a great deal of luck. The inverted investor, armed with their checklist of failure modes and their pre-mortem analysis, approaches the problem differently. They don't start by looking for the gold. They start by building a sieve designed to filter out the clay. Their first questions are about downside, not upside. Does this company have too much debt? Is its business model too complex to understand? Is it in a dying industry? Is management untrustworthy? With each yes, another clay marble is removed from consideration. After this rigorous filtration process is complete, the barrel is no longer filled with thousands of marbles of dubious quality. It now contains a much smaller, pre-qualified group of mostly silver and gold marbles. The odds of success have been dramatically shifted in your favor before you even begin the work of picking individual stocks. This act of systematic subtraction is the most powerful form of addition an investor can practice. It is the very essence of portfolio protection, ensuring that the capital you have worked so hard to accumulate is not squandered on the predictable and avoidable mistakes that plague the majority of market participants. This is how you build a foundation for true, lasting wealth preservation. The second great pillar of our inverted philosophy requires us to confront a powerful cognitive illusion that distorts our view of reality every single day. It is called the fallacy of the survivor, and it is the hidden engine behind almost every bad piece of business and investment advice. To understand it, we must leave the world of finance for a moment and travel back to World War II, to a team of mathematicians and engineers in New York City tasked with a life-or-death problem. American bomber planes were being shot down over Europe at an alarming rate, and the military needed to know where to add more armor. The problem was, armor is heavy. Too much, and the plane becomes sluggish and fuel-guzzling. Too little, and it's a flying coffin. So they gathered data. They meticulously examined every bomber that returned from a mission and mapped out the locations of the bullet holes. The data was clear. The fuselage and the wings were riddled with holes, while the cockpit and the engines were relatively untouched. The military command's conclusion was logical, intuitive, and completely wrong. Reinforce the areas with the most bullet holes, they ordered. That's where the planes are being hit. It was a statistician named Abraham Wald who saw the fatal flaw in their reasoning. Wald, a quiet genius who had fled Nazi-occupied Austria, pointed out that their analysis was only looking at the planes that Toff made it back. They were only seeing the survivors. The bullet holes on the returned planes represented areas where a bomber could take damage and still fly home. The truly critical data was missing. The silence from the planes that didn't return was the most important information of all. The reason there were no bullet holes in the engines of the surviving planes was that planes hit in the engine didn't survive. They were at the bottom of the English Channel. The armor, Wald declared, doesn't go where the bullet holes are. It goes where the bullet holes aren't, on the engines. His insight saved countless lives and perfectly illustrates the danger of survivorship bias. This same bias permeates the world of business and investing. The books we read are about Steve Jobs and Apple, Jeff Bezos and Amazon, Sam Walton and Walmart. These are the planes that made it back, riddled with the bullet holes of near disaster but ultimately triumphant. We study their every move, their management techniques, their product strategies, and we try to draw universal lessons. But we are missing the data from the thousands of other consumer electronics companies, e-commerce startups and retail chains that had similar ambitions, similar strategies, and equally brilliant founders, but are now nothing more than forgotten footnotes in business history. We don't see the graveyard. By focusing only on the winners, we create a dangerously misleading narrative of cause and effect. We might conclude that dropping out of college is a good strategy for becoming a tech billionaire because we see Bill Gates and Mark Zuckerberg, but we don't see the millions of college dropouts who did not become billionaires. We are looking at the bullet holes and drawing the wrong conclusions. Warren Buffett understands this intimately. While the rest of the world studies his successes, he spends a great deal of his time studying failures like the collapse of long-term capital management, a hedge fund run by Nobel laureates that nearly brought down the global financial system. He studies these events to understand the patterns of ruin, to see where the planes that didn't come back were hit. This is the intellectual discipline that separates a true student of business from a mere fan of success stories. Survivorship bias is a particularly potent psychological trap because it feels so natural. It confirms our desire for simple, clean narratives. It tells us that success is a formula that can be replicated, that there's a clear path to follow. The reality of business is far messier. It's a complex adaptive system involving luck, timing, competition, and countless other variables. Survivorship bias strips all that complexity away and leaves a cartoon caricature of success. It makes us believe that success was inevitable. Looking back at the rise of a company like Google, it's easy to construct a story that makes their dominance seem preordained. Of course they won, we say. They had a superior algorithm. But this ignores the graveyard of other search engines from that era, AltaVista, Lycos, Excite, that also had brilliant engineers and innovative technology. Focusing only on Google blinds us to the true base rates of success in the search engine wars of the late 90s, which were incredibly low. This cognitive flaw is amplified 1,000-fold by the media and publishing industries. There is no market for books titled "How My Mediocre Company Went Bankrupt." The headlines that grab our attention are about unicorns, billionaires, and overnight successes. This constant drumbeat of victory creates a warped perception of reality, making success seem far more common and failure far more rare than it actually is. This is a critical failure in our collective financial education. We teach people to idolize the winners without ever forcing them to perform an autopsy on the losers. As a result, investors develop an inflated sense of what's possible. They see the 1-in-a-million lottery winner and think the odds are in their favor, forgetting about the millions of losing tickets that financed the jackpot. This mindset is the enemy of sound risk management and the primary psychological driver behind speculative bubbles. A key component of improving one's financial literacy is to actively fight this bias, to force oneself to look at the whole picture, not just the prettified, airbrushed portrait of the victor. To counteract this powerful, pervasive bias, you must build a new mental habit. You must become a curator of failure. I call this the building the graveyard model. It is a systematic process for recalibrating your brain to the true realities of the business world, a practical blueprint for any retail investor who wants to develop a professional-grade sense of skepticism. Step 1 is to actively seek out examples of business failure. Don't wait for them to come to you. Once a month, make it a project to identify a company that was once a market darling, a can't-miss stock from 5, 10, or 15 years ago that has since collapsed or faded into obscurity. Think of companies like BlackBerry, once the undisputed king of smartphones, or MySpace, the social media giant before Facebook, or any number of the hyped-up 3D printing or clean energy companies from the early 2010s that are now bankrupt or trading for pennies. Step 2 is to use the internet as a time machine. Go back and find the primary source documents from that company's peak. Read the euphoric analyst reports predicting endless growth. Read the fawning magazine profiles of its visionary CEO. Watch the old interviews where executives made bold promises about changing the world. Immerse yourself in the bullish narrative of the time. You must understand, on a gut level, how compelling the story was. What were the key arguments for why this company was a guaranteed winner? Write them down. Step 3 is the autopsy. Now shift your research to the present day and read the postmortems. What actually happened? Read the bankruptcy filings, the news articles explaining the downfall, and the retrospective analyses. Was it a new technology that disrupted them? Did they fail to adapt to changing consumer tastes? Did they take on too much debt to fund aggressive expansion? Was there fraud or mismanagement at the executive level? Meticulously document the real reasons for the failure. Step 4 is the most important. Compare the two narratives. Place the list of bullish arguments from the peak next to the list of reasons for the ultimate failure. This is where the learning happens. You will begin to see patterns. You will notice how the very things that were celebrated as strengths were often the seeds of destruction. Perhaps the visionary CEO was actually an arrogant leader who refused to listen to dissenting opinions. Perhaps the rapid growth that everyone applauded was fueled by unsustainable debt. This exercise does something remarkable to your brain. It trains you to recognize the sound and shape of a bubble. The next time you hear an analyst on television using the same breathless, story-based language to describe a current market darling, a little alarm bell will go off in your head. You will have heard that song before, and you will remember how it ended. Building your personal graveyard of failed investments is a powerful form of mental vaccination against the hype and euphoria that lead to the most catastrophic stock market mistakes. It is a masterclass in due diligence. The antithesis of this approach, the path of the 99%, is a world of guru worship and superficial mimicry. Instead of building a deep understanding of business principles from a wide range of outcomes, most people look for shortcuts. They buy books with titles like The Warren Buffett Way or Trade Like a Stock Market Wizard, and believe that the secret to success is simply to copy the habits or strategies of a famous investor. This is the ultimate expression of survivorship bias. It's like trying to become a great basketball player by only studying Michael Jordan's highlight reels. You see the spectacular dunks and the game-winning shots, but you don't see the thousands of hours of grueling practice, the hundreds of missed shots for every one that went in, or the specific context of the team and the era in which he played. This desire to copy the survivor leads people to focus on the wrong things. They might adopt Buffett's famous taste for cherry Coke, thinking it's part of the magic, while completely ignoring the far more important but less visible habit of reading 500 pages a day. They might try to replicate a famous investor's latest stock pick without understanding the deep research and specific valuation that went into that decision. This leads to a cargo cult mentality, where people perform the rituals of success without understanding the underlying principles. They are just going through the motions, and when the market environment changes, their copycat strategy falls apart because they don't know why it worked in the first place. For any entrepreneur or investor, the lesson is clear: do not try to be the next Steve Jobs. Instead, study the hundreds of thousands of failed entrepreneurs and understand the common reasons they went out of business: running out of cash, not finding product-market fit, co-founder disputes, and make it your mission to avoid those specific pitfalls. This is a far more reliable path to building a sustainable enterprise than trying to replicate the unique genius of a once-in-a-generation outlier. The direct financial connection between understanding survivorship bias and your investment returns is profound, particularly when it comes to valuation and stock picking. Survivorship bias is the fuel that inflates asset bubbles. Because we are constantly bombarded with stories of the massive winners, our expectations for future returns become skewed. We start to believe that 100-to-1 returns are a common and achievable goal. This leads investors to overpay dramatically for companies that have already experienced great success. They look at a company that has grown at 30% a year for the past decade, and, falling victim to both survivorship and recency bias, they extrapolate that growth rate far into the future. This is what leads to a popular technology company trading at a price-to-earnings ratio of over 100. A price like that is not just a vote of confidence. It is a price that assumes perfection. It assumes the company will never face a serious competitor, never make a strategic misstep, never be disrupted by a new technology, and never face a recession. In short, it assumes this company is immune to all the diseases that have killed off its rivals. An investor who has diligently built their graveyard knows how ludicrous this assumption is. They have studied the carcasses of dozens of former high flyers, and they know that moats can be breached, industries can be upended, and no company is invincible. This sober understanding of the base rates of business mortality provides a powerful anchor for valuation. It allows you to look at a hyped-up growth stock and say the story is exciting, but the price already reflects a perfect future. The odds are that the future will be less than perfect. The risk here is far greater than the potential reward. This discipline, born from studying failure, is what prevents you from buying into bubbles at their peak, and is the very foundation of intelligent value investing and risk management. It keeps your capital safe while others are being washed away by the tide of euphoria. Having established the philosophy of inversion and the danger of survivorship bias, we now arrive at the third pillar, where the abstract becomes concrete. This is about transforming our study of failure into a tangible, actionable tool. This is the pillar we call the autopsy of disaster, the process of building your personal anti-portfolio checklist. This is perhaps the most crucial step in systematizing your investment approach, moving from a reactive, emotional process to a disciplined, rational one. A checklist is not a substitute for deep thinking, but rather a scaffold for it. It ensures that in moments of excitement or fear, you don't forget the hard-won lessons from past disasters. The perfect anecdote to illustrate the power of this approach comes, perhaps surprisingly, from one of Warren Buffett's greatest successes, his 1973 investment in the Washington Post. At the time, the newspaper industry was in turmoil. It was the Nifty 50 era, a time when investors were infatuated with fast-growing one-decision stocks and were largely ignoring old media companies. Many newspapers were struggling with high costs, powerful unions, and the emerging threat of television news. The industry was a minefield. Buffett, however, didn't just stumble upon the Post, he approached the industry like a pathologist. He performed a deep autopsy on the entire newspaper sector, identifying the specific characteristics that were causing most newspapers to fail. He created a mental checklist of what to avoid. On his pathology checklist were items like being the number 2 or 3 paper in a 2-paper town, which was a brutal, low-margin business, having a weak brand that didn't command reader loyalty or advertiser dollars, facing crippling labor union disputes that drained cash flow, and operating in a market with declining demographics. After studying the failures, he had a crystal-clear picture of what a dying newspaper looked like. Then, and only then, did he start looking for a company that was the exact opposite. The Washington Post was not just a good company, it was a company that lacked all the fatal diseases killing its competitors. It was the dominant paper in its market, a virtual monopoly in the politically influential and growing city of Washington, D.C. It had an ironclad brand, strengthened by its recent Watergate reporting. It had a non-unionized press room, a massive cost advantage, and it was being run by a family, the Grahams, who were fanatical about the quality of the product and had a shareholder-friendly mindset. Buffett bought the Post not just because it was cheap, but because it passed his anti-failure checklist with flying colors. His investment analysis was an act of inversion. He used his deep knowledge of the industry's graveyard to identify one of the few truly exceptional survivors. The psychological principle that makes a checklist so powerful is its ability to counteract what psychologists call the availability heuristic. This is a mental shortcut where we tend to judge the likelihood of an event by how easily we can recall examples of it. After a plane crash, for example, people's fear of flying skyrockets, even though the statistical probability of a crash hasn't changed. The vivid, emotionally charged memory of the crash is now highly available in their minds, making the risk seem larger than it is. We can use this heuristic to our advantage. By actively studying business disasters like Enron, Lehman Brothers, or WorldCom, we are intentionally populating our minds with vivid, memorable stories of failure. When you create a checklist item that says check for signs of aggressive or fraudulent accounting, your brain doesn't just see the words. It recalls the story of Enron's off-balance sheet partnerships and Arthur Andersen shredding documents. When your checklist says avoid companies with extreme leverage, your mind flashes to the image of Lehman Brothers, employees carrying their boxes out of the office in 2008. The checklist acts as a triggering mechanism for these cautionary tales. In the heat of the moment, when you might be tempted by a compelling growth story, the checklist forces a pause. It systematically brings these memories of disaster to the forefront of your consciousness, acting as a powerful psychological brake on greed and impulsivity. It makes the lessons of the past readily available when you need them most, ensuring that you don't repeat the same well-documented mistakes. It's a way to weaponize hindsight, a critical component of financial literacy. Now, let's build the blueprint for your own investment checklist. This should be a living document that you add to and refine over your entire investing career. But we can start with a robust framework based on the most common categories of business failure. This is not about finding reasons to buy, it's about finding reasons to say no and move on. The faster you can discard bad ideas, the more time you have to focus on the truly great ones. Category 1 is financial frailty, which is an autopsy of the balance sheet and cash flow statement. Your checklist here should include questions like, is the debt-to-equity ratio consistently above 1? A company that owes more than it owns is inherently fragile. Is the company consistently burning through cash, negative free cash flow? A business that cannot generate cash from its own operations is living on borrowed time. Does the company rely on creative or non-GAAP accounting metrics to tell its story? Look for a large gap between reported net income and actual cash flow. Are accounts receivable growing much faster than revenue? This can be a sign of a company stuffing the channel or faking sales. These are the vital signs of a business. A weak balance sheet is like a pre-existing condition. The company might survive in good times, but it will not withstand the stress of a recession. Category 2 is competitive erosion, an autopsy of the company's moat. A moat is a durable competitive advantage that protects a business from competition, just as a moat protects a castle. Your checklist should ask, is the company's industry undergoing rapid, unpredictable technological change? Think of Kodak and the rise of digital photography. Are new, low-cost competitors entering the market? Think of how generic drugs decimated the profits of brand-name pharmaceuticals after their patents expired. Is the company's primary product or service at risk of becoming a commodity? This happens when customers can't tell the difference between one company's product and another's, and they start making decisions based solely on price. A shrinking moat is a clear sign that a company's future will be much less profitable than its past. Category 3 is management malpractice, an autopsy of the leadership team. Great businesses can be run into the ground by bad management. Your checklist must probe for signs of untrustworthy or incompetent leadership. Questions to ask include, is the CEO overly promotional and focused on the stock price rather than the long-term health of the business? Read their shareholder letters and listen to their conference calls. Is executive compensation tied to short-term, easily manipulated metrics like quarterly earnings, or is it linked to long-term value creation like return on invested capital? Is there high turnover in key executive positions, particularly the chief financial officer? A revolving door in the CFO office is a massive red flag for accounting issues. Is the company a diversification story, constantly making acquisitions in unrelated fields they don't understand? This is often a sign of an empire-building CEO whose ego is out of control. This is a critical area of due diligence for entrepreneurs and investors alike. By methodically going through a checklist like this for every potential investment, you are creating a firewall. You are ensuring that every company in your portfolio has passed a minimum threshold of financial strength, competitive durability, and management integrity. The path of the 99%, the antithesis of this disciplined approach, is a chaotic journey from one hot tip to the next. The average retail investor doesn't have a system. Their process for stock picking often begins with a story they heard on the news, a stock symbol they saw in an online forum, or a recommendation from a friend. Their due diligence, if any, is usually superficial. They might look at a stock chart to see if it's going up, and perhaps glance at the last quarter's revenue growth. They operate on gut feelings, intuition, and emotion. They are drawn to exciting narratives and charismatic leaders, the very things a rigorous checklist is designed to protect against. This lack of a systematic process makes them incredibly vulnerable to their own psychological biases. When the market is roaring, they are overcome with greed and FOMO, fear of missing out, and they chase stocks at absurd valuations. When the market panics, they are paralyzed by fear and sell good companies at bargain prices. They are constantly reacting, always on the back foot. They are playing a game of chance, hoping to get lucky. The investor with a checklist is playing a different game entirely. They are playing a game of skill, based on a repeatable, rational process. They are not immune to emotions, but their checklist acts as a circuit breaker, forcing them to be logical when others are being emotional. This disciplined approach to capital allocation is the single greatest advantage a retail investor can have over the emotional crowd. The direct financial connection of using a checklist is the dramatic reduction of unforced errors. In tennis, amateur matches are not won by the player who hits the most brilliant winners. They are won by the player who makes the fewest simple mistakes. Investing is much the same. Most investors don't fail because they miss out on the next Amazon. They fail because their portfolios are riddled with companies that were obviously bad ideas from the start, over-leveraged, competitively weak, poorly managed businesses that eventually blow up. Avoiding a single 50% loss is a far more powerful driver of long-term returns than finding an extra 100% winner. Let's look at the simple, brutal math. If you invest $10,000 and it loses 50%, you now have $5,000. To get back to your starting point, you don't need a 50% gain, you need a 100% gain. The deeper the loss, the more heroic the required recovery. A checklist is a tool designed specifically to help you avoid those deep, portfolio-crippling losses. By systematically screening out companies with the highest probability of failure, you are protecting your base of capital. You are keeping your compounding machine intact. A portfolio that grinds out solid returns and avoids major drawdowns will, with mathematical certainty, end up with far more money over the long run than a volatile portfolio that experiences spectacular booms and devastating busts. This is the simple, unglamorous secret to wealth preservation. It's not about hitting home runs. It's about not striking out. Your investment checklist is your personal rulebook for how not to strike out. Now we must descend deeper into the anatomy of disaster. While our checklist can have dozens of items, experience shows that the vast majority of corporate fatalities can be traced back to a small handful of recurring, powerful pathogens. These are the horsemen of the financial apocalypse, the three primary forces that lay waste to shareholder capital time and time again. If you can learn to spot and avoid these three things, you will have eliminated the most common causes of permanent capital loss. The three horsemen are debt, ego, and complexity. The quintessential story of how these three forces can combine to create a perfect storm of destruction is the spectacular collapse of long-term capital management in 1998. This was not a case of amateur investors getting in over their heads. LTCM was a hedge fund founded by a Mount Rushmore of financial superstars. Its partners included John Meriwether, the legendary bond trader from Salomon Brothers, and two Nobel Prize-winning economists, Myron Scholes and Robert Merton. These were, by any objective measure, some of the smartest people in finance, and this is what makes the story so terrifying and so instructive. Their high IQs made them, if anything, more susceptible to the lethal cocktail of the three horsemen. First came complexity. LTCM's strategy was based on convergence arbitrage. They used complex mathematical models to find tiny, temporary pricing discrepancies between related securities around the world. For example, they might notice that a 30-year U.S. Treasury bond was trading for a fraction of a penny more than a slightly different 29.5-year bond. Their models told them that, eventually, these prices should converge. They would make massive bets on these tiny spreads, believing them to be near certainties. The problem was, the models were so incredibly complex that virtually no one, perhaps not even the partners themselves, truly understood all the embedded assumptions and risks. They had built a black box and put their faith in its theoretical elegance. Next came ego. The partners at LTCM were the high priests of finance. They had Nobel Prizes. They had legendary track records. They believed they had unlocked a new, scientific way to invest that was virtually risk-free. This led to a staggering level of hubris. When other lesser mortals questioned their strategy or their risk levels, they were dismissed as not being smart enough to understand. Their early successes further inflated their egos, creating a feedback loop of overconfidence. They believed they were intellectually immune to the kind of risks that plagued ordinary investors. Finally, and most lethally, came debt. Because the spreads they were betting on were so minuscule, the only way to generate impressive returns was to use an astonishing amount of leverage. For every $1 of their own capital, they borrowed more than $25. But even that number is misleading, because it doesn't account for the embedded leverage in the derivatives they were using. By some estimates, their true leverage ratio was over 100 to 1. They were a ticking time bomb. The fuse was lit in 1998 when Russia defaulted on its debt, an event their models had deemed nearly impossible. This triggered a global flight to safety, causing all of their carefully calculated spreads to diverge wildly instead of converging. The black box broke. Because of their massive leverage, their small losses were instantly magnified into catastrophic, firm-ending losses. They faced margin calls they couldn't meet, and the fund was on the brink of a collapse so large that the Federal Reserve had to orchestrate a multi-billion-dollar bailout from Wall Street's biggest banks to prevent a chain reaction that could have toppled the entire global financial system. The story of LTCM is a permanent monument to the destructive power of debt, ego, and complexity. It serves as a stark reminder that intelligence is no defense against irrationality. Let's dissect the underlying psychology of each of these three horsemen, because they prey on our most basic human instincts. Debt, or leverage, is the great accelerator. It taps directly into our greed and our impatience. It promises to get us to our financial goals faster. It takes a good story and makes it seem irresistible. Why settle for a 10% return when you can borrow money and potentially make 30%? This is the siren song of leverage. On a psychological level, it short-circuits our perception of risk. The possibility of accelerated gains feels tangible and exciting, while the risk of ruin feels abstract and distant. A margin call is the moment that abstract risk becomes a terrifying reality. It's the point where you are forced to sell your assets at the worst possible time, locking in permanent losses. Leverage transforms a temporary market downturn into a personal catastrophe. It is the single fastest way to go from rich to poor. Ego is driven by the overconfidence bias we discussed earlier, but it's often supercharged by the Dunning-Kruger effect. This is a cognitive bias where people with low ability at a task overestimate their ability. In finance, it often manifests in executives who have had a string of successes, perhaps due to luck or a favorable market environment. They begin to believe they have a golden touch. Their ego becomes so inflated that they shut themselves off from criticism and contrary opinions. They surround themselves with sycophants who reinforce their belief in their own genius. This is particularly dangerous for entrepreneurs who have built a successful company. They can fall into the trap of believing their success in one domain makes them an expert in all domains, leading them to make disastrous capital allocation decisions, such as a high-priced acquisition in a field they know nothing about. An unchecked ego is a blinking red light for any investor. Complexity preys on our fear of looking stupid. This is a surprisingly powerful social force. Many investors, when faced with a business model they don't understand, be it complex financial derivatives, a highly technical biotech company, or a convoluted software platform, will not admit their ignorance. They will nod along pretending to understand because they don't want to appear unintelligent. They invest based on faith in others, assuming that the experts must know what they're doing. This is a complete abdication of an investor's primary responsibility: to understand what you own. Warren Buffett's famous too hard pile is the perfect antidote. If he can't understand a business, he simply doesn't invest. He is not afraid to say, "I don't know," an admission that is a sign of supreme intellectual confidence, not weakness. Complexity is often a cloak for risk. If a business is too complicated to explain, it's often because there's something to hide. The applied mental model here is the three horsemen filter, a simple, devastatingly effective first-pass screen for any potential investment. Before you do any deep research, before you read a single analyst report, you subject the company to this three-part test. It takes less than 15 minutes and will allow you to discard the vast majority of dangerous investments immediately. Step 1 is the debt test. Open the company's most recent quarterly report and go straight to the balance sheet. Find the total liabilities and shareholders' equity lines. Is the first number bigger than the second? If so, be very, very careful. Now, go to the income statement and the cash flow statement. Find the company's operating income or cash flow from operations and compare it to its interest expense. Is the company earning enough to comfortably cover its interest payments many times over? If the balance sheet is heavy with debt and the interest coverage is thin, the company fails the test. Put it in the no pile. The story doesn't matter. The charismatic CEO doesn't matter. The potential for growth doesn't matter. A fragile balance sheet disqualifies it from consideration. Step 2 is the ego test. This is a qualitative test, but no less important. Your mission is to get a sense of the character of the CEO and the culture of the company. The best source for this is the annual shareholder letter. Read the last 5 years of letters. Is the language humble and straightforward, or is it filled with jargon and self-congratulatory platitudes? When things go wrong, does the CEO take responsibility, or do they blame external factors? When things go right, do they share the credit with their team, or do they present themselves as a lone genius? Another great tool is listening to the quarterly conference calls. Pay attention to how the CEO answers tough questions from analysts. Are they transparent and direct, or are they evasive and dismissive? An arrogant, self-aggrandizing CEO is a liability waiting to happen. If the ego test raises red flags, put the company in the no pile. Step 3 is the simplicity test, also known as the explain it to a fifth grader test. Take a piece of paper and try to write down, in 1 or 2 simple sentences, exactly how this company makes money. What is the product or service? Who are the customers? Why do they buy from this company instead of a competitor? If you find yourself struggling, if you have to use complex jargon, if you're not entirely sure what they do, the company fails the test. It goes into the too hard pile. This isn't about you not being smart enough. It's about the company not being a good enough investment. The best businesses are almost always simple to understand. The 99% of investors are moths to the flame of these 3 horsemen. They are drawn to leverage through products like options and speculative penny stocks, seduced by the fantasy of a quick fortune. They are captivated by the larger-than-life, visionary CEOs, mistaking showmanship for substance. And they are intrigued by complexity, believing that a company with a complicated, futuristic-sounding technology must be a sophisticated investment. They see these 3 traits not as red flags, but as badges of honor. The recent collapse of the family office Archegos Capital Management is a modern-day LTCM. Its founder, Bill Hwang, was known for his massive ego and unwavering self-belief. His strategy was impossibly complex, involving total return swaps and other opaque derivatives. And his use of leverage was biblical, allowing him to build $100 billion positions with just a fraction of that in actual capital. When a few of his bets went sour, the entire house of cards collapsed in a matter of days, inflicting billions in losses on the world's largest investment banks. It was the same old story: debt, ego, and complexity leading to ruin. The direct financial connection is that these 3 horsemen are the leading indicators of financial fragility and the highest predictors of a stock going to zero. A highly leveraged company has no margin for error. A minor business hiccup or a slight rise in interest rates can trigger a death spiral. An ego-driven CEO is prone to disastrous capital allocation decisions, like overpaying for a transformative acquisition that destroys shareholder value. A complex business is a black box. It's impossible to value with any confidence, and it can conceal hidden risks that only become apparent when it's too late. By applying the 3 horsemen filter, you are systematically removing the companies with the highest probability of a catastrophic blow-up from your portfolio. On a balance sheet of your returns, avoiding a single stock that goes to zero is a massive victory. Each zero you successfully avoid is a powerful boost to your long-term compound annual growth rate. This isn't just risk management. It is a direct and powerful way to enhance your returns by focusing on the preservation of your capital. We have now arrived at the final pillar, the culmination of our entire philosophy. This is where we connect all the threads: inversion, survivorship bias, checklists, and the avoidance of the 3 horsemen to the ultimate financial goal. We will see that capital preservation is not a timid, defensive strategy for the fearful. It is the ultimate offensive weapon for the intelligent investor. It is the engine of long-term wealth creation. It's about understanding that the key to getting rich is to first ensure you never have to start over. The most powerful illustration of this principle in action is Warren Buffett's performance during the 2008 global financial crisis. The years leading up to 2008 were a period of wild speculation, particularly in the housing market. Wall Street was drunk on leverage and complexity, creating mortgage-backed securities and collateralized debt obligations that almost no one understood. Buffett, true to his principles, sat out the party. Berkshire Hathaway was criticized for holding too much cash, for being too conservative, for being a relic of a bygone era. Buffett was a dinosaur, they said, who didn't understand the new world of sophisticated finance. But Buffett was simply following his rules. He avoided what he couldn't understand: complexity. He avoided companies with reckless balance sheets, debt. And he avoided the hubris and euphoria of the times, ego. He was focused on wealth preservation. Then the storm hit. In the fall of 2008, the system collapsed. Lehman Brothers went bankrupt. AIG, the world's largest insurer, required a government bailout. The credit markets froze, and panic swept the globe. The very institutions that had been mocking Buffett were now on their knees, desperate for capital. And who was there, sitting on a mountain of cash, his fortress-like balance sheet completely unscathed? Warren Buffett. He was not a victim of the crisis, he was its savior. While others were being forced to sell their best assets at fire sale prices, Buffett was on the offensive. He injected $5 billion into Goldman Sachs and $3 billion into General Electric on terms that were almost unbelievably favorable to Berkshire Hathaway. He was getting preferred stock with massive dividend yields plus warrants that gave him huge upside potential. He was able to do this for one reason and one reason only: his decades-long fanatical devotion to risk management and avoiding losses had put him in a position of unimaginable strength when everyone else was weak. His conservative capital preservation strategy transformed in an instant into the greatest capital allocation opportunity of his lifetime. He wasn't just surviving, he was thriving because he had avoided the mistakes that had crippled everyone else. This is the ultimate power of a defense-first approach. It allows you to not only survive the storms but to emerge from them stronger than ever. The psychological principle that makes capital preservation so critical is one of the most fundamental biases in the human brain: loss aversion. The pioneering work of psychologists Daniel Kahneman and Amos Tversky showed that, for most people, the psychological pain of losing $1 is roughly twice as powerful as the pleasure of gaining $1. Our brains are wired to be far more sensitive to losses than to gains. This has profound implications for investors. It explains why people hold on to losing stocks for too long, unwilling to realize the painful loss. And, most importantly, it explains why people panic and sell everything near the bottom of a market crash. The emotional pain of seeing their portfolio value decline becomes unbearable, and they sell to make the pain stop, often just before the market turns around. Buffett's entire system is an elegant, lifelong strategy to manage the destructive power of loss aversion. By focusing so intensely on the downside before he invests, by ensuring he buys good businesses at fair prices with a margin of safety, he dramatically reduces the probability of ever being in a situation that triggers that deep, primal panic response. He is not trying to be a hero and gut it out through a 50% drawdown. He is trying to construct a portfolio of businesses so resilient and so reasonably priced that they are unlikely to ever experience that kind of permanent impairment of value in the first place. His financial education is, at its core, an education in emotional control, and the best way to control your emotions is to avoid the situations that are known to hijack them. Wealth preservation is not just a financial strategy, it is a behavioral one. The applied mental model that operationalizes this principle is the framework of the asymmetric bet. This is often summarized as, heads I win, tails I don't lose much. It is the practical blueprint for putting capital to work once you've filtered out the obvious losers. It is a mindset that shifts the focus from how much can I make to how much can I lose. Step 1 is to rigorously define your downside. Before you allow yourself to dream about the potential gains, you must establish a plausible, conservative estimate of your worst-case scenario. What happens if your growth thesis is completely wrong? Is there a floor to the stock price? You can estimate this by looking at tangible asset values, like the company's net cash on the balance sheet or its liquidation value. The goal is to anchor your analysis in a conservative estimate of what the business would be worth in a pessimistic scenario. Step 2 is to ensure that this defined downside is limited and, crucially, survivable. This means two things. First, the potential loss on any single investment should never be 100%. You are looking for situations where, even if things go badly, you are likely to get most of your money back. Second, the The size of your position must be managed so that even if your worst-case scenario comes true, the loss will not significantly impair your total portfolio. As the old saying goes, never make a bet that you can't afford to lose. This is the essence of portfolio protection. Step 3, and only after you have established a firm floor on your downside, is to analyze the upside. Now you can allow yourself to think about what could go right. What is the realistic potential for this business to grow and compound its value over the next 5 to 10 years? Step 4 is to act only when there is a significant asymmetry between the potential upside and the limited downside. You are looking for opportunities where the potential gain is many times the potential risk. A true value investor might look for a situation where they believe their downside is limited to perhaps 10 or 20%, while the upside could be 100% or more. They are seeking 5-to-1 or 10-to-1 bets, not 50-50 coin flips. This patient, disciplined search for asymmetric opportunities is the hallmark of a professional capital allocator. The path of the 99% is, once again, the polar opposite. The average retail investor is almost exclusively focused on the upside. They are drawn to symmetric or, even worse, negatively asymmetric bets. Buying a speculative, cash-burning story stock is a classic example. The potential upside, in their imagination, is 100x, a life-changing return. The downside, which they rarely consider, is a near certainty of losing 100% of their investment. This is a heads I get rich, tails I lose everything proposition. It is not an investment. It is a lottery ticket. This approach is a fundamental misunderstanding of probability and the mathematics of long-term wealth creation. It is a recipe for eventual ruin, because if you repeatedly make bets where the most likely outcome is a total loss, you will eventually go broke. This brings us to the final and most important direct financial connection, the simple, inescapable mathematics of compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world. It is the engine that can turn modest savings into a substantial fortune over time. But the machine is fragile. The single biggest threat to the magic of compounding is large losses. The math is unforgiving. A single 50% loss requires a 100% gain to recover. A 90% loss requires a mind-boggling 1000% gain just to get back to where you started. The journey back from a deep drawdown is exponentially harder than the fall. Therefore, the most important lever you can pull to maximize your long-term wealth is not to maximize your annual returns in the good years, but to minimize your losses in the bad years. A portfolio that returns a steady, unspectacular 8% a year with minimal drawdowns will end up with vastly more money than a portfolio that returns 25% one year and loses 15% the next. The avoidance of losses is a more powerful mathematical driver of final wealth than the magnitude of gains. This is the ultimate secret. This is the financial transformation. By building your entire investment philosophy around the study of failure and the preservation of capital, you are not being conservative. You are being aggressive. You are aggressively protecting your compounding machine from the one thing that can permanently break it, a catastrophic loss. You are ensuring that you stay in the game, that your capital base remains intact, and that the eighth wonder of the world can work its magic for you, year after year, decade after decade. This is the surest path to achieving genuine financial literacy and lasting financial freedom. You have just invested a significant amount of your most valuable asset, your time, to fundamentally rewire your approach to investing. You have moved beyond the superficial stories of success and learned to see the world through the clear, sharp lens of inversion. You now possess a powerful mental toolkit that the vast majority of investors will never discover. You understand that the architecture of avoidance is the strongest foundation you can build. You can see the invisible illusion of survivorship bias. You have the blueprint to build a rigorous, unemotional investment checklist, and you know to flee at the first sign of the three horsemen: debt, ego, and complexity. You have learned how to make the preservation of your capital not just a defensive tactic, but your most potent offensive weapon. This is a profound shift in perspective, one that can protect you from the most common and costly mistakes that plague the market. But what you have mastered today is one half of a powerful equation. You have built the ultimate filtration system, a powerful shield designed to eliminate the losers, the frauds, and the failures. You have constructed the negative half of the system. This is an absolutely essential, non-negotiable first step. But after you have filtered out all the junk, after you have said no 100 times, you will eventually be left with a small, elite group of potential opportunities. And at that point, a new question arises. How do you identify the truly exceptional businesses among them? How do you distinguish the good from the great? The study of failure tells you what to avoid, but a complementary body of knowledge is required to understand what to embrace. The negative checklist you've just built must be paired with a positive checklist, a set of specific, rare, and durable characteristics that define the world's greatest compounding machines. Mastering the art of avoidance protects your capital. Mastering the art of identifying quality is what allows that capital to grow exponentially. One cannot function without the other. What you have learned is the shield. The video that is now appearing on your screen is the spear. It is the other side of the coin, the missing link that connects the architecture of avoidance to the architecture of success. It is the next piece of the map. Amateurs in this game are always looking for a hot tip. Professionals build systems. You have just laid the foundation for the defensive half of your system, the part that ensures you stay in the game. The choice to click is the choice to build the offense. It is the decision to complete your mental arsenal and to make the final transition from a hopeful participant to a true capital allocator.